Okay, good evening, everyone. I hope you're all doing good. Before I start lecturing, today gonna be the last lecture, and I would like to make some announcement. I would like to make some arrangements concerning the final examination itself. So, concerning the first thing that I would like to tell you, I shared the CFA book. Where is it? First, I shared the CFA book. It is available in Moodle, and it's here. So this is the first thing. The second thing, I want to arrange with you the final examination, when we may have the final exams with you. And
is it possible on next Wednesday?
Next Wednesday.
I mean, if everyone agrees to that, or so that because like we'll have an exam on first and on third, I think also, but
on the 6th of May, yes?
Yeah, if possible, and if everyone agrees to that. If
Guys, please write in the chat. Just put the plus who is agree on the Wednesday, or just put everybody. I want everybody to just put the plus in the chat who is agree for Wednesday. Alia, what does 3 mean?
I mean on Monday.
Monday.
Mm-hmm.
Islam for Monday, Alia for Monday. Islam and Alia, why you can't have on Wednesday?
No, I can have on Wednesday, but as soon as possible would be better just to finish
But
everything.
majority is voting
Okay, then.
for
Okay, let's do
Wednesday.
it on Wednesday.
Islam, is it okay with you Wednesday?
It's okay.
If it is really difficult to go with Wednesday, no problem. I can arrange separately for you the exam. If there is something with urgent, like you may have 2 exams at Wednesday. Is it like this?
No.
No, I just saw that you separated to the groups, so I thought anyway the exam is different or something. Okay, I mean, just like Friday or something, I'm gonna have this thesis defense, so I wanted to buy some time, like, and make it.
Okay. The
much
exam
better.
exam will be 1 hour. Okay, 60 minutes. Just be aware of it. And I'm planning to make in the exam the following lectures. Just wait. I'm just gonna type it. So Wednesday.
It's okay with me.
At 18 or class hour. Is it okay?
Teacher, can you make it 1 hour and 50 minutes because we have some internet?
No. Don't
connections.
worry. No, I mean the question will be arranged for you for 60 minutes, but I'm gonna give you 10-20 minutes more. Don't worry about it.
Oh, okay.
Can we do it in the day?
In daytime.
Like during the day.
Not in the evening.
The problem is what, guys, when you do it in the day, the probability is having internet problems is high, because in daytime there's a high school using the Zoom. People are using too much internet.
Okay.
That's why I'm making evening. Evening, it's much more better, and it's less probable to have any problems in connections. That's why.
I cannot do during the day because I'm working. Only in the evening.
Yeah. There's another issue. Yes, some evening is good. I can make it even later at 11 o'clock if you want. 11 p.m.
No, 7 is okay.
Okay. There will be lectures. I'm planning to give you 3. 3, 4, and 5. Balance sheet, income statement. So income statement, balance sheet, and technical ratio analysis. Okay, I decided today to go with the technical ratio analysis because in cash flow statement there is nothing too much, but it's better for us to go with the technical ratio analysis, like overall picture.
Professor, one more
Yes.
question about questions. Is it similar to what we did in the class? Like
I'm going to come to that. I'm going to come
Okay.
that. For the question types, whatever we did in the class, you're responsible for it. How you can study, how you can practice it. I put the CFA book in Moodle, and there at the end of each chapter, there's an end questions, okay? In
Okay.
the CFA. They are with answers. So in each chapter, there are around 12 questions. So in total, we have 40 questions. Just study them. This 40.
How many questions?
40
How many
questions.
chapters?
3 chapters. Lecture 3, 4, 5. Income statement,
Okay.
balance sheet, and the ratio technical ratio analysis. CFA end
Okay.
questions. Study them. And this is on Wednesday. The date, let me put it so that they can. Date is, I think, 6th of May. The time is so quick. Oh my gosh. I don't know how we just started and it's already ends. Okay. Wednesday. Okay, lecture 3, 4, 5. They're all available here, plus CFA book. And concerning article, I decided to postpone it till 4th of May. How many midterms you? How many final exams do you have before?
I
3.
think 2. Well, I mean, it depends.
Before Wednesday, how many final exams you have it?
2.
3. 2.
4.
Well,
Different.
3,
Different.
3.
Guys,
3 of
for me, what is important? Okay, I'll put the due date 10th of May. Okay, I'm not in rush to get this article. So due date 10th of May. Submit. If you submit earlier, good. If you submit that day, that's fine. So you have to submit on the 10th. So I don't want you to put the pressure on the article and to take you away from studying for the final exam. So study for the final exam and leave the article to the last part. Okay, this is the thing that you should do actually.
Thank you.
So
Okay,
due date.
thank you.
Due date.
Thank you, Professor.
thank you
You're
very
welcome.
much.
You're welcome.
And is
Okay.
it? Okay.
Yes, Janai.
Is it possible later on to have like discussions with you through Zoom if we have questions about the article?
Definitely. Just
Okay, excellent.
just type
Yeah.
me and write me, and I
Okay,
will be able
thank you
to
very
get
much.
this Zoom as soon as I'm free.
Okay,
Actually. No
so
problem.
we still have some time.
Okay. Okay. If everything is fine, then next I want from you, how am I going to arrange the exam? My question, do you all have the laptops?
Yes, we have. I have.
Yes.
I have
So-
computer only. I don't have laptop.
No problem. Computer or the laptop, not the mobile. I don't want you to solve the question through the mobile because there are the students who are solving the questions through the mobile.
No, we all have laptops.
Okay, you all have the laptops. Great. This is another thing. What I want from you, how am I going to arrange the quiz exam? It will be open-end questions like problem solving. Okay. And I want from you to arrange the exam in the following way. Just let me share the picture with you. Where was it? Can you install the Zoom to your mobile?
Yes.
Yes.
So I want you to install the Zoom to your mobile and put it on the right or the left corner so that you can see your computer and you, actually your hands. There was a picture. Proctor. Something like this. Okay, can you see it?
Yes.
I'm not saying that you are cheating or something, just to be on the safe side. Okay, guys? So put on the right or left, or put on the table that you're studying, and just put the book and next, link your mobile to the book, and it will stay like this. I mean, everything will be like seeable. I can see your hands, and I can see your whatever you call the desktop, laptop screen. And the questions are not complicated. You know my way of asking the questions. I'm asking straightforward questions. For me, is not to make you to fail or something. Is just to know that you really understood everything, all the chapters. That's it. So CFA questions are straightforward. Study them. You'll have the similar questions.
Are there only calculations or theory?
All of them calculations, and calculation plus theory together. Like I want you to calculate something and give interpretation on it. I want you to understand what you are calculating.
Okay.
So, Professor, if we read the book and your lectures, it will be enough.
Yeah, read the lectures and solve the CFA end of the questions. That will be more than enough.
Okay. And what chapters in the book? It's 3, 4, 5?
In the book, it is go by names: income statement, balance sheet, and here we go. Let me open. Look here. Financial analysis techniques, and understanding balance sheet, and understanding the income statement. Here.
Okay.
And this one. Today we're gonna study it. Okay. Then we are agreed on Wednesday at 7 o'clock. Lectures are good. Okay. We agreed on in which way we're gonna organize it. That's perfect then. So we can move to lecture then. Okay, today we're gonna discuss financial analysis techniques, and it is very good that actually you're already familiar with the ratios because you already solved them, you already seen in other courses, you know how to calculate and everything. So I will not spend a lot of time in explaining specifically the calculation part. The most important is to try to get a very necessary information that provides each ratio that we use it. So actually there are many techniques and the tools that are used in financial analysis of the financial statements that converts them into a certain format in order to make them interpreted easily and understood easily. These are the techniques are ratio analysis, the mostly that we're going to be concerning about in this chapter. Common size analysis, they're like horizontal and vertical analysis in common size, graphical analysis, and the regression analysis, which is very familiar to you now. You're already in this regression analysis. You know how to do the regression analysis, you know how to interpret your results, and so on. So we don't spend the time on regression analysis in this chapter, but you already spent a lot on the regression analysis, and you know really better than enough. Let me see where I am recording. Yes, I'm recording it. Okay. So the ratio analysis the ratios are very useful tools for expressing the relationship among the data that can be used for within the companies and across the companies as well. So they're often used to identify the questions that need to be answered. Those questions are followed down. You can see the first and one of the main questions is the future project earnings and the cash flows, how you can predict, how you can forecast the cash flows for the companies. The second is the firm's flexibility, or you're measuring the capability of the firm to grow and while growing to meet its obligation. The flexibility of the firms is important, and interested parties are shareholders and the creditors. The third question that is very important for the ratio analysis is assessing the management performance. The fourth one is evaluating the changes in the firm's industry or within the firm itself. And the fifth is the comparing the firm with the firm's industry competitors. It is very important. Like, we are not doing separately for the firm, and we're not like making that we will not compare. So the matter is to compare. So whatever the results you get, you compare. The same thing you learned in the article. While writing the article, whatever results you're getting, you're comparing with the other results. Why? With the purpose to show how much you progressed, how much the banking in that field is progressed, or whatever the evaluation you were making, you were trying to show how much they were progressed. So as a financial analysis, you should be also aware some limitation of the ratios. My gosh, what is this? That including the following. First, the financial ratios are not useful when they viewed as separately without like comparison. When you don't compare with the historical performance of the same company, like what happened in the previous years, you don't compare with this. So the ratios are not be useful as much as you compare. The comparison with other companies, it is making you more difficult because of the different accounting system used. So whenever you make some analysis, you should be taking into consideration that these companies might be using different system. Like one of them using IFRS, the other one is using GAAP. The conclusion cannot be made by calculating a single ratio. All ratios should be kind of interconnected. So you should kind of relate them to each other. And another one as additional, it is difficult to find a comparable industry ratios when analyzing the companies. And the last one, determining the target or comparison value for ratio, it is very difficult task. It requires some range of acceptable values. So coming to the common size analysis, basically common size statements, they normalize the balance sheet and the income statement and allows the analysis to more easily compare the performance across the firms or for a single firm over the time. It makes a kind of standardization. It converts into standardized format so you can easily compare if they're different in size, if they're different in currency, if they're different in industry. So there are two types of common size analysis exists. Is one of them vertical common size balance sheet, and the other one horizontal. In vertical common size balance sheet, they express all the balance sheet account as a percentage of total asset, and the vertical common size income statement, they express all income statement items as a percentage of sales as 100%. There's an example I'm going to share with you. We're not going to calculate, we've already done it so far. And coming to the second type of common size horizontal, it is another way to present the financial statement in the way the divisor is first year values. So they're all standardized to one. Like, so the first year, the current year is like standardized and is a kind of base year. You take as a base year, from the base year, you just go away. Like from the first year till, I don't, let's say we're in 2020 now, and you want to compare from 2010 to 2020 the years. So 2010 is the base year. From 2010 to 2020, you're gonna make this percentage conversion on horizontal. So here the example is given the vertical common size balance sheet, how they're converted. So from up and down, sorry, it's not a balance sheet, it's an income statement. Why did I write here balance sheet? Anyway, it's an income statement. Anyway, it's an income statement, but this is income statement as well. Anyway, you know, by mistake, I put the income statement here. It should be balance sheet. You know how to get the balance sheet. Total asset we are getting as 100%, and the other accounts are derived from this 100%. And coming to income statement, here you go. But horizontal way, it's you go from left to the right. So this is the period one, it's a base year. This is how you just calculate the changes from base year to the second year, from base year, and it goes like this. We're given 2 years, we're comparing like base year and the current year, like current year and the previous years. We can see the change, and the change is 56%. And here the change is, in absolute term, is 1,900, is decreased 21%. So there is a reduction in change. This is we call a horizontal common size balance sheet and horizontal common size income statement. So we're going horizontal from left to the right. But when it comes to vertical one, we go from up down or from down to up. Okay, when it comes to the graphical analysis, the graphs are used to visually to present the financial performance comparison and the composition of the financial statements elements over the time. The stake column graph, we're gonna see the later in the picture, and it can be used some line graph to measure, to understand. Here we can see that trade payables and lease obligation, cash and long-term debt, like from 2004 to 2008, the cash is increasing and then it starts a bit fall. But we can see that trade payables, they go kind of stable, then it goes increasing, but they have increasing money. And from 2006 to 2008, the lease obligation increased dramatically. There was no lease obligation before, but they increased it. And at the same time, what happened? The long-term debts increases as well, same time. No, long-term debts, sorry, because of the contrastness of it, I cannot just figure out. This is debt and this is cash. Yes. So the upper one, the bars are upper, the bars are the long-term debt. This is the cash. The cash is going down. The leasing going up. So when the cash is going down, it gives you the information that there is a problem with the liquidity. You may have it. So as it proceeds, you may use this diagram, you may use this graph as forecast model as well, based on the historical performance. Like from the historical performance, you can see that the cash is going down and becomes smaller, and the obligations are becoming higher and higher. So working capital management is deteriorating, because working capital management, we said, is what? It is difference between the current asset and the current liability. It can be measured in the line as well. So long-term debt increases in here at the beginning. Then from 2007 to 2008, it falls. Then the cash is going down historically, like from 2004 2008. The lease obligation has got the pattern of increasing pattern, and the trade payables, they're increasing. So we can get the information from here, still like liquidity issue. Regression analysis, the analysis that are used to identify the relationship between variables, like GDP. For example, you might use the relationship between GDP and the sales to operate, or in your case, like you use the profitability ratio. You try to see what is the relationship with the independent variables, like bank specific and the macroeconomic variables. So coming to the classification scheme of financial ratios, we can say there are mainly 4, but then there's evaluation ratios as well, which is related to dividends payout ratios, dividend issue, the equity side mostly. But first 4 ratios are related to overall performance of companies. Activity ratio is the category that includes the ratios that show the utilization or turnover ratio. They often give indication of how well the firm utilized acquired assets, such as inventory or fixed asset or receivables. But when it comes to liquidity, it shows how the ability of the firm to pay the short-term obligation when they come due. And the solvency ratio, they're mainly related to the long-term obligations. It's all about the bankruptcy cost, it's all about the bankruptcy issue. And the profitability ratio, they provide information how well the company generates money from operations and from the net profits from its sales. So we are given here the example of activity ratios. One is receivable turnover, the other and inventory turnover. As we said, receivable turnover, it shows how efficiently you're turning over or utilizing your receivables against the sales. In order to calculate more in a detail, we may use like days of sales outstanding, like it shows how many days it takes to receive the money, because we know the account receivable is what is the goods and services that are traded on a credit basis. So you sell it and you are expecting to receive it in the future. So when this ratio, days of sales outstanding, so for receivable turnover ratio, the higher is better. But when it comes to here, when it's too high, it may indicate that the customers are too slow in paying their bills. So how long it takes to come. Let's say if it's 300, it will be 300 days it will take to collect the receivables. When it's too low, it will show how tough the firms in terms of their credit policy. So we need to be sure where it's too tough, and we are not for the case of when it's too high and when it's too low. So when it's too high, it's not good. When it's too low, it's not good as well. So it should be something middle, because when it's too low, it really destroys the sale, because creditors are selling less. So the firm is selling low because of the toughness of the credit. And that's why you will not be able to realize a lot of profit in the future time. So you should be very careful about this firm to see. So everything is the matter of comparing to the industry norm, okay? There should be some industry norm and you make comparison about it. So there should be always the benchmark. You shouldn't evaluate, oh, if it's too high, then these guys are really doing bad. Or if it's too low, it's good because the creditness of this company is good, so they collect in a short period of time. So it's not the case. So when it comes to the inventory turnover, it shows the efficiency of how you turn over your inventory, how you efficiently resell your goods that you keep in the company. And coming to days of inventory turnover, how frequently you utilize your inventory in terms of days. When it's too high, that may lead to show that inventory is Absolutely, like it takes a long period of time to realize the products or the goods that you keep in your firm. So it means that the products or goods you keep in the inventory they're already old because you cannot sell them frequently. So maybe you received them a couple years ago and now they're here, and it may give you a good indication that firms purchase this inventory and they're old and they're already due to be depreciated. So there's some expenditure, some expenses can come out at the end of the period. So what may happen, you may take this into consideration, and it should not be too low as well, because if it's too low, like that indicates that the firm is inefficient in terms of realizing their stocks. That will hamper the sales as well. Okay, let's talk about the payables. Payables turnover, it shows how efficiently the firm pays their payables, their bills within the 365 days. And the number of the days of payable refers how long it takes to pay their bills, to pay their payables actually. Okay, we're coming to the total asset turnover ratio. It's another part of the activity ratio. These are the shown the how efficiently the assets are utilized to generate the revenue. So the from industry to industry, the indicator may change. For example, for manufacturing indicators, for manufacturing businesses, the capital intensive might have asset turnover ratio equal to 1 or near around the 1. Why? Because they are more capitalized based. But for retail businesses, they might have ratio near 10. So comparing retail business with the manufacturer business and saying that one has got 10, the other one is 1, so the one who has got the 1, they are performing bad. So it's not necessarily like this. So you should be very careful when you compare in this way. You should compare with the similar industry if you can make a comparison. And because from industry to industry, the norm or the benchmark, it changes. So the low asset turnover ratio might indicate that the company has too much capital tied up in an asset base, but too high of ratio, it may indicate that there are too few assets for potential sales. So when it comes to the fixed asset turnover, it's same thing. It shows you how frequently you're using your asset to generate the revenue, but more specifically, we're talking about the fixed assets. Okay, we're talking about the fixed assets. And we should be very careful. When we come up with the too high indicator, it might indicate that the firm has got old equipment, or it at its minimum. Definitely this firm will incur a capital expenditure in the near future. That will increase the capacity to support the growing revenues. And coming to the working capital turnover, how the firms are utilizing their working capital turnover, whether they're meeting their revenues using this management, this working capital management properly, that will lead to higher profits. And we know the working capital is just current assets minus current liabilities. When the firms, they have very low working capital, that may show you that outstanding payables are more than receivables. Like current liabilities are higher than the current assets. That will definitely increase revenue. Oh, sorry, what I'm saying, just lost my mind. No, if the current liability is higher than the current assets, that will definitely reduce the revenue side as well, and the working capital turnover ratio will go down. Okay, this will all were about the activity ratios. And guys, for the final exam, I want to make you some clarification that you don't have to memorize the ratios. Please put down on small paper just ratios before you're going to show me that paper, but without any extra information. That's just this ratio. These ratios, you can just use it as a from the paper, okay, to calculate it. So liquidity ratio, we talked about it. It is all about showing how much money the company generates in short term to meet their obligations, the debts, short-term debt. So we've got like very popular ratio, like current, quick ratio, cash ratio. And we talked a lot already in the balance sheet about it. We said the current ratio is less realistic, showing the less realistic picture than the quick ratio. And the most realistic picture is shown by the quick ratio about the liquidity position, because it takes only the ready cash converted items to current liabilities. But in here we have marketable securities, receivables, but in here we have inventories and etc. and other things. So all current assets. So the most realistic picture is all about cash ratio. So there's another liquidity ratio was invented recently. It is defensive interval. It's a defensive ratio. It is just in here, mainly in the cash ratio, it is similar to quick ratio actually, but with one concern. In defensive interval, it is just showing the relationship to expenses rather than to liabilities, rather than the to current liabilities. So this ratio is showing you more, or the most realistic picture of the liquidity position, I believe, because it shows the relation, the current assets to its expenses rather than to its current liabilities, whether this company is able to meet their expenses now. Okay, there's another liquidity ratio, which is cash conversion cycle. It just showing you how long it takes to turn the firm's cash investment into inventory back into cash. So this firm of collection from the sales, the higher the conversion of the cycles, the less liquid the position of that firm. So we are willing to have lower the ratio in this cash conversion cycle. But when it comes to solvency ratio, they include two types. One is debt ratio, the other one coverage ratio. And these are all based on different statements. Like debt ratio is based on the balance sheet, and the coverage ratio is based on the income statement. So when we talk about the solvency, we talk about long-term ability to meet the obligation, and it shows the leverageness, and it shows from how the assets are financed, by how much it's being financed by debt, and by how much it's being financed by equity. So total debt equity ratio, total debt or total equity, total debt capital is total debt or total debt plus total shareholders equity. Total debt, debt to asset ratio, total debt to total assets. You know, in some country, basically, generally, these two ratios are the same thing, because total debt plus total shareholders equity is gonna bring you to total asset. But according to some authors, they say no, they are differentiating these two ratios. They are differentiating because total shareholders equity, they are including only the common shareholders, common stock, and retained earnings. Other things that are in equity is not included in this total debt equity ratio. Is it clear?
Yes.
Okay.
Yes,
In total assets, it includes total debt and total equity, everything. We know in total equity what is included: other comprehensive income, it includes return on equity, it includes additional return earnings, it includes treasury stocks and everything. So in here, it includes only common stock and return earnings, but it changes from author. But some authors, they say no, they're the same thing. So they're indication of same thing. So when it comes to the financial leverage, it's a new ratio was invented as well by some author. I don't remember the name of the author who was that person, but anyway, he created that average total assets over the average total equity. And in here, they're trying to underline by how much the total asset is utilized to generate some $1 from equity side. And when it says the average in here is taking like beginning and the ending value. So average of the beginning and ending. Mainly about this ratio, the remaining risk, it helps to determine the ability to repay its debt obligation. This is the information that we can derive from this debt-based ratio. But from when it comes to the coverage ratio, it's interest coverage and the fixed charge coverage. And interest coverage, as the name speaks itself, like the ability to cover the interest. In the second one is the same, but it gives you more realistic picture about the ability to cover the periodical payment. Okay, we come to the profitability ratios. Profitability ratios mainly measure how much profit was generated by utilizing certain revenue. So the net profit margin is the relation, the net income to revenue. Gross profit margin is the gross profit to revenue, is like revenue minus cost of goods sold. You come up with a gross profit. There is a profit which is generated, profit margin operating, which is operating income over revenue, like how much in terms of percentage from sales that you sell the goods and services generated from the operational side of the firm. What about the pre-tax, like before paying the tax margin? The popular one, which is return on asset, ROA as abbreviated, is net income over the average total assets. And yes, you have question?
Yes, revenue is the same as sales.
Yeah, revenue is exactly the same sale. It's the same. In revenue in here, it means a sales that you sell the product. The money that comes from the selling product.
And average total assets, how to calculate average
It's
total?
beginning of asset and ending asset, average of it. If beginning asset was 10 and the ending was 15, the average is 10 plus 15 divided by 2.
Okay.
12 and a half. Return on asset, there is another way of derivation. I forgot, one author derived it. They say it's better to use the return on asset like net income plus interest expense, which is, we can say it's kind of showing like capability to meet its earnings before interest, like bringing the interest expense back, but with adjustment to the tax rate. So you are bringing the interest back here to show more realistic picture about the profitability, like return from assets. But there's operating return on assets, which is EBIT, earnings before interest tax, divided by average total assets. There's a return on total capital. It's EBIT over average total capital. There's return on equity, is net income over total equity, average total equity. And return on equity, like more comprehensive one, is derived by authors. Actually, there are thousands of ratios like you can derive from the profitability ratio. It depends on your capability to manage and to derive from the income statement and using the balance sheet together. But these are the most famous ones that are used as a profitability indicator, like how the profits are measured. They say that to come up with the net income, we should make it net income minus preferred dividends, like net income to common before paying the regular shareholders dividends. Okay, if there are companies that have preferred shares and they pay preferred stocks, so which means for you to calculate the return on equity, like return from utilizing the equity, to take into consideration the preferred dividends, because these are the priority people who will get the first dividends. Then if you're a shareholder, you will get later than these guys. Okay, these are the ratios that you should know: profitability, liquidity, and solvency, and activity ratios. You should know the meaning behind each ratio. Coming to this example, we are given the balance sheet in here. In here, we are given the income statement. But this is for current year, this is for the previous year. Income statement is given only for current year, for today's. And there is a financial ratio template, like last year calculation ratios given and industry. So here's the example that you should go. Using the company's information provided, calculate the current year ratios, discuss how these ratios compare with the company's performance last year with the industry performance. So we need to calculate the ratios in here. And how we will do it? We will do it through ratio that was provided before. So current ratio, you know already. Okay, tell me. Current
Total assets.
Current assets minus
Current liability divided by current liability.
Which is current assets is 620 here, yes?
Mhm.
Divided by current liability. Where is our total current liability? I cannot see it here. Current liabilities is here, 325, okay? So 620 divided by 325 will give you if you calculate
1.9.
1.9. Now, compare with industry, compare with last year. So if you compare with the industry, you outperform the industry. You perform still good in terms of liquidity position if you take current ratio, and you are good. However, if you compare with the last year performance, you're down performing. The performance is not good. So this is how the comparison is made. However, if you want to get more realistic picture, we know that there is no guarantee that inventory will be turned over efficiently, so that we should be very careful about it. We need to take into consideration more realistic picture of the liquidity, which is quick ratio. And the quick ratio was cash plus receivable plus marketable securities and divided by current liabilities. So cash is here, you cannot see it. Cash is here. Receivable is here. We're going to add them all plus marketable securities. Do we have marketable securities?
Cash and
No.
marketable securities are together.
Yeah, they're all together. So we don't have to add it separately. So what we do here, cash, let me see the cash. Calculate, please get the calculator. 105 plus 205 divided by
125.
325 makes
0.9.
4.9. Okay, we go to the days of outstanding. So in here, let's comment first of all. The quick ratio is lower than the previous year, isn't it? Yes, it is. We're down perform, but in the line with the industry average is same. So it goes consistent with the industry. So we're not bad that much. Even though we're down performing, but still we are good in terms of industry. So days of sales of outstanding is 365 days divided by receivable turnover. But receivable turnover is calculated sales divided by receivables. So first of all, sales divided by receivables, how much? Here with sales, we have it. Our sales is 4,000 divided by receivables.
It's 19.51.
Wait. 19.51. Okay. And divide 365, you get how much?
18.7.
18.7.
18.7, yes?
Yes.
So still we are down performing in terms of previous year, but we are more than industry. Okay, inventory turnover. So this is the how it's calculated. This is how it's made the comparison, guys. So let's not waste the time on this calculation. It's straightforward calculation. I just show you how to use it. I hope there is no questions. This is question from CFA, by the way. The solution is available in the CFA. You can check it and explanation as well. Okay. Once you understood everything, we can just proceed it. Okay. We came to another topic, which is in ratio analysis. It's a DuPont identity system. DuPont identity, it is basically a return on equity that shows the net profit margin, asset turnover, and leverage ratio. Like three ratios are combined together. How it is combined, we're going to derive it. But why we need to have the DuPont identity in here? The investors or analysis, they said, in order to be able to capture three things in one ratio. First of all, profitability, activity ratios, the turnover ratios, the efficiency in using the assets, and the debtness of the company, the leverage position of the company. So three things will be captured in the DuPont system. That's why some analysis, they use the DuPont identity. But how they're deriving? We know that the return on equity is equal to net income by average equity. This is what we know, yes? Then what is done is we multiply this equation, the right side of the equation, by revenue over the revenue. So we multiply this side revenue by revenue. With the multiplication, we have to rearrange it. When you rearrange it, net income becomes over revenue, and revenue becomes over average equity. And then we go with following. We come up with net profit margin and equity turnover. Then, of course, we multiply the right side, this equation. We multiply with total asset over the total asset. We rearrange it. We come up with this formula, which is net profit margin, which is total asset turnover ratio, and which is leverage ratio. So this ratio is used to capture three things, okay? And why we need to have the DuPont identity? We said to break down the function into three, it's leverage, profit margin, turnover. And ROI, when it's relatively low, it must be that at least one of the following true. The poor profit margin, or poor asset turnover, or too little leverage. So this is the information why the return on equity is lower. So if the ROI is lower in comparison to industry, in comparison to the previous years, then it happens due to this reason. So it, in your mind, profit margin, asset turnover ratio, and leverage. Here's an example. You can solve it. It's easy, just putting and just replacing it. I'm not gonna go over it. It's just straightforward. Just replace the numbers. If you will have some still questions, you will be always welcome. I'll be pleased to help you to answer. But I'm just skipping this part. I'm just leaving to you to digest yourself. So some question as well. And there is another way DuPont identity, which is extended to 5-way. So return on equity, this is the normal one, we have it. Then there's an extension. There we're adding EBT, earnings before tax, over EBT. So we multiply this part by EBT over EBT, and we multiply this part with EBIT, earnings before interest tax, over EBIT. And then we rearrange it, and we're gonna come up with this thing. Here, then when we extend our DuPont identity to 5-way, it is including now 5 factors. One is tax burden, net income over EBT. The other one, interest burden, EBT over EBIT. EBIT margin, the profitability, asset turnover, and leverage. Now, using this calculation, if this ROE is becoming lower, this will be for you an indication why it became lower, why it downperformed, either because of the tax burden or interest burden, or poor performance of profitability, or poor performance of asset turnover, or poor performance of the leverage ratio. So this is why we use DuPont identity. One is a 3-way, the other one is a 5-way. Here's an example. And here how they solve it. Just straightforward. At the end, they come up with this ratio. And still, you need to compare. Everything is matter of comparison with the previous year and with the industry. Okay, valuation ratio are used in analysis for investment in common equity. They're basically related to EPS and diluted EPS. We already studied and we calculated. What is a diluted EPS? It is using like what if analysis. It is calculated to be lowest possible EPS that could have been reported if all firms that can be converted into common stock, and that would decrease basic EPS if everything was converted. So it is kind of helpful for us to calculate if there is a like shares that should be converted, like treasury stock, there are warrants stock, preferred stocks, and we have convertible bonds as well. We're assuming if they converted, what would happen? So it can give you a kind of what if value analysis. And coming to the dividend, there is another way we need to talk about sustainable growth. Sustainable growth is the rate of return on resources that is measured by return on equity capital, or basically as abbreviated, it's ROE. So the proportion of the earnings as reinvested as known as retention ratio, abbreviated as RR. Sustainable growth rate is basically showing you how the firm can grow without additional external equity issues while holding the leverage constant. We're assuming that ceteris paribus, like nothing changes, and while we will use in our existing equity, how the firm will grow. So this growth is equal to RR times ROE. RR is retention ratio, how much money is retained in the company. And in order to find the retention ratio is 1 minus dividend payout ratio. We know that net income is divided into two parts. One is going to as dividends to shareholders, and the other stream will go to the companies as retained earnings or additional to retained earnings. So this retention ratio comes from retained earnings. So retention ratio RR times ROE, it will give you a sustainable growth rate. RR is found in the way 1 minus dividend payout ratio, and dividend payout ratio is equal to dividend declared over the net income available to common stockholders. Here's an example of calculating that it's giving you. So here's an answer. You can go over it again. So let us talk about the business risk. The business risk is the firm when it faced the business risk, and the scholars they decided to measure the business risk. It's better to use the standard deviation. And using the standard deviation equation, they try to see by how much their net income is deviating, by how much their operating income is deviating, their revenue is deviating. The higher the deviation, the more is uncertainty about their financial performance. So the higher the uncertainty about the financial performance, the higher the risk in this company, because as an investor, you want to invest in a stable company which has got lower deviation. So there are some ratios are created, like coefficient variable sales deviation, variation in sales is standard deviation of sales over the mean sales. Mean sales is average sales. Coefficient variation operating income is standard deviation of operating income divided by mean of operating income, the average of operating income. And coefficient variation net income is standard deviation of the net income divided by mean of net income. So this is all that I want to discuss with you guys. If you have any questions, I will be pleased to answer. If you have any questions, I will be great to come with some answers.
Yeah, I have a question.
Yeah, please.
So when we compare two companies and compare the coefficient, the DuPont ratio, so which one is better, the highest one or the lowest one?
DuPont ratio, DuPont identity, yeah, of course, the highest one. Return on equity is showing the profitability ratio. Yes, it's showing the profitability, because the lower of this DuPont identity, it indicates there is something wrong with one of the three following, or if you're measuring like 5-way of DuPont identity, it means there is something wrong with this one of 5. Like one is the tax burden, the other one interest burden, the other one leverage, profitability, and asset turnover ratio. You have to check that thing. That's why I said at the beginning, never come up with a single ratio analysis. All the ratio that you use, they should be somehow correlated to each other.
Yeah. Thank you.
Okay, you're welcome. Do you have any questions?
Professor, question about the Stata.
What's wrong with Stata?
When I run this regression with FGLS, all my variables become not significant.
It's good. Then it means your model is not significant.
But is it okay if our model is not significant, for example?
Yeah, it is okay, because you will prove it. This is another proof that you are not you're proving that these variables doesn't affect the profitability. So anyone who says in order to increase the profitability, you should increase these variables, increase some changes in it, so you will prove the opposite side. No, in order to improvement doesn't come with these variables.
So I can interpret even if all are insignificant, yeah?
Yeah, yes, you will make some interpretation.
Okay, okay, thank you.
Anissa, can you share before when you will run regression today? Asela did the sharing analysis with me. I want you to share as well because I want everyone to share this analysis. Try it yourself to make it, but give me 10 minutes in the Zoom when you will have a free time. Share your screen and show me how you get this result. That I want to be sure. Like from beginning, like making tests for autocorrelation and coming with the FGLS.
Can I share now?
No, now unfortunately I don't have a time because I'm fasting.
Yeah, and if possible, could you please upload it when you actually share it so we can also